How to start Forex trading in 2026 beginner to profitable. What if I told you that thousands of people open a Forex trading account every single day? But most of them will lose money, not because they're unintelligent, not because the market is manipulated, and not because they chose the wrong strategy. They lose because they start the wrong way. The internet makes Forex look easy. Social media is filled with luxury cars, expensive watches, screenshots of huge profits, and influencers promising that you can turn a small account into thousands of dollars in just a few weeks. It sounds exciting. But what you don't see are the blown accounts, the emotional stress, the sleepless nights, and the years of learning that successful traders go through before they become consistently profitable. The truth is simple. Forex is not a get-rich-quick scheme. It is a skill. And like any skill, it takes time, discipline, and practice to master. If you're watching this video because you've never traded before, or you've already lost money and want to start over the right way, then you're in the right place. In this video, I'll walk you through everything a beginner needs to know about Forex trading in 2026. We'll cover what Forex actually is, how the market works, how to choose a broker, how to place your first trade, how to manage risk, how to control your emotions, and finally, what it really takes to become profitable over time. By the end of this video, you'll have a clear roadmap that can save you months or even years of costly mistakes. So grab a notebook, eliminate distractions, and let's begin. What is Forex? The word Forex stands for foreign exchange. It is the global marketplace where one currency is exchanged for another. Think about traveling to another country. If you travel from Ethiopia to Europe, you'll likely exchange Ethiopian birr for euros. If you visit the United States, you'll exchange your money for US dollars. That exchange is part of the Forex market. Now imagine this happening every second. Banks exchanging billions of dollars, governments managing reserves, companies paying international suppliers, tourists exchanging currencies, investment funds buying and selling based on economic expectations. Together, these activities create the largest financial market in the world. Every day, trillions of dollars are traded in the Forex market. Unlike the stock market, Forex operates almost continuously from Monday to Friday, following major financial centers around the world. Because the market is so large and liquid, traders can usually buy or sell currencies quickly. Why do people trade Forex? People trade Forex for different reasons. Some want an additional source of income. Some enjoy analyzing financial markets. Some hope to build long-term trading skills. Others are simply curious after seeing videos online. Whatever your reason, it's important to have realistic expectations. Trading is not a guaranteed income. Professional traders don't win every trade. Instead, they focus on making good decisions over hundreds of trades, knowing that some wins and some losses are part of the process. This mindset is one of the biggest differences between beginners and experienced traders. Beginners often chase quick profits. Experienced traders focus on consistency. The biggest myth about Forex. One of the biggest myths is that Forex is an easy way to become rich. If that were true, everyone would be doing it successfully. The reality is very different. Many beginners deposit money without understanding risk. They copy signals from strangers. They use high leverage without realizing the potential downside. They trade based on emotions instead of a plan. After a few losses, they either give up or start risking even more to recover quickly. This creates a cycle that drains both their account and their confidence. The market isn't trying to defeat you. Most of the time, traders defeat themselves through poor decisions. That's actually good news. Because if your habits are the problem, your habits can also become the solution. What you'll need before you start, before risking a single dollar, there are a few things every beginner should have. First, a willingness to learn. Second, patience. Third, discipline. These three qualities are more valuable than any trading indicator. Many people spend weeks searching for the perfect strategy. Very few spend time building the habits that make a strategy work. Remember this, a good strategy with poor discipline often loses. A decent strategy with strong discipline can become consistently profitable over time. Your goal isn't to make money yet. This may sound strange. But when you're new, your first goal should not be making money. Your first goal should be learning. Think about a pilot. Would you want a pilot to fly passengers on the first day of training? Of course not. Pilots spend many hours learning, practicing, and using simulators before taking responsibility for real flights. Trading should be approached the same way. Your early focus should be understanding the market, managing risk, and building consistency. The profits come later. And when they do, they're much more likely to last. Part 2, understanding how the Forex market works. Now that you understand what Forex is, it's time to learn how the market actually works. This is where many beginners become overwhelmed. They hear words like pips, leverage, margin, spreads, lot sizes, liquidity, and candlesticks, and they immediately think Forex is too complicated. But here's the good news. Every professional trader was once confused by these same terms. Once you understand the basics, everything starts to make sense. So let's simplify it. Understanding currency pairs. In Forex, you never buy or sell a single currency. You always trade one currency against another. This is why currencies are traded in pairs. For example, EUR, USD, GBP, UST, USD, JPY, USD, CHF. Let's take the most popular pair in the world, EUR, USD. The first currency, the euro, is called the base currency. The second currency, the US dollar, is called the quote currency. If EUR, USD is trading at 1.150, it means 1 euro is worth 1.15 US dollars. When you buy EUR, USD, you're expecting the euro to become stronger than the dollar. When you sell EUR, USD, you're expecting the euro to become weaker than the dollar. It's really that simple. You're trading the relationship between two currencies, not predicting whether one currency is good or bad. Why do currency prices move? This is one of the most important questions in trading. Currencies move because supply and demand change. Imagine investors believe the US economy is getting stronger. Maybe inflation is falling, employment is improving. The central bank raises interest rates, businesses are growing. Foreign investors may want to hold more US dollars. As demand for the dollar increases, its value can rise against other currencies. The opposite can happen if economic conditions weaken. This is why traders pay attention to interest rate decisions, inflation reports, employment data, GDP growth, political events, central bank speeches. Prices move because millions of participants are constantly reacting to new information. Understanding candlestick charts. When you open a trading platform, you'll see a chart. Most traders use candlestick charts because they provide a lot of information in a simple visual form. Each candle represents price movement over a specific period of time. It could represent 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, 1 day. A bullish candle shows buyers were stronger during that time. A bearish candle shows sellers were stronger. Every candle tells a small part of the market story. When many candles form together, they begin to reveal trends, reversals, and areas where buyers or sellers are gaining control. Learning to read price action takes practice, but it becomes much easier over time. What is a pip? One of the first words every beginner hears is pip. A pip is simply a unit used to measure price movement. Think of it like measuring distance. We use meters or miles to measure length. Forex traders use pips to measure price changes. For example, if EUR USD moves from 1.100 to 1.1010, it has moved 10 pips. If it moves from 1.100 to 1.1050, it has moved 50 pips. This makes it easy for traders around the world to discuss price movements. Instead of saying, the market moved from this number to that number, they simply say, the market moved 50 pips. Understanding lot sizes. Now let's talk about lot sizes. A lot size determines how much currency you're buying or selling. There are different sizes: standard lot, mini lot, micro lot, nano lot offered by some brokers. The larger your lot size, the more money you can gain or lose with each price movement. This is why beginners should never focus on making the biggest trades. Successful traders first learn to protect their money. Once consistency is built, position sizes can gradually increase. What is leverage? Leverage is one of the biggest reasons people become interested in Forex. It allows traders to control larger positions using a smaller amount of money. For example, with leverage, a relatively small account can open trades much larger than its cash balance. This sounds exciting, but it comes with significant risk. Leverage magnifies gains, but it also magnifies losses. Many beginners believe higher leverage automatically means higher profits. In reality, high leverage without proper risk management is one of the fastest ways to lose an account. Professional traders don't rely on maximum leverage. They rely on disciplined risk management. Understanding margin. Margin is closely related to leverage. Think of margin as the amount of money your broker sets aside while your trade is open. It isn't a fee. It's simply part of your account that's temporarily reserved to support your position. If your losses become too large, the broker may automatically close positions to help prevent your account from going below required limits. That's why understanding leverage and margin before trading with real money is so important. What is the spread? Every trade has a small cost called the spread. The spread is the difference between the buying price and the selling price. Think of it like exchanging money at an airport. The rate to buy a currency is often slightly different from the rate to sell it. That difference is similar to the spread. Some currency pairs usually have smaller spreads than others, especially those that are traded more frequently. Lower spreads can reduce trading costs, particularly for traders who enter and exit the market often. When does the Forex market open? One advantage of Forex is that it operates almost 24 hours a day from Monday through Friday. As financial centers around the world open and close, trading activity shifts across time zones. The major trading sessions are commonly referred to as Sydney, Tokyo, London, New York. Not every session has the same level of activity. When the London and New York sessions overlap, trading volume often increases, and many currency pairs experience larger price movements. However, more movement doesn't automatically mean better trades. Patience is still essential. The market doesn't owe you anything. Here's a lesson every trader eventually learns. The market doesn't know who you are. It doesn't know your account balance. It doesn't care if you won yesterday or lost 5 trades in a row. Every trade is independent. Your job isn't to control the market. Your job is to control your decisions. You can't control whether the next trade wins or loses, but you can control how much you risk. Whether you follow your trading plan, whether you trade with discipline, whether you keep learning after every trade. Those are the things that separate long-term traders from those who quit after a few months. Part 3. Choosing a broker and placing your first trade. At this point, you understand what Forex is and how the market works. Now comes the exciting part: opening your trading account and preparing to place your first trade. But before you deposit any money, there's one decision that can have a huge impact on your trading journey. Choosing the right broker. Think of a broker as the bridge between you and the Forex market. Without a broker, you can't buy or sell currencies. Not all brokers are the same. Some provide reliable trading platforms, competitive spreads, and good customer support. Others may have poor execution, high fees, or unreliable service. So, how do you choose a good broker? First, look for a broker that is regulated by a recognized financial authority. Regulation doesn't guarantee success, but it helps ensure the broker follows established rules designed to protect clients. Next, compare trading costs such as spreads and commissions. Lower costs can make a difference over hundreds of trades. Also consider deposit and withdrawal methods, customer support, and whether the broker offers a free demo account. A demo account is one of the most valuable tools for beginners because it allows you to practice without risking real money. Demo account versus live account. Many beginners skip the demo account because they want to make money immediately. That can be an expensive mistake. A demo account uses virtual money but real market prices. It lets you learn how to use the trading platform, place orders, set stop losses, and build confidence. However, remember that trading with virtual money feels different from trading with your own money. When real money is on the line, emotions become much stronger. That's why it's important to treat your demo account seriously. Follow a trading plan, keep a journal, practice proper risk management. When you've shown consistent results over time, then consider moving to a small live account. Installing your trading platform. Most Forex traders use platforms like MetaTrader 5, often called MT5, or other platforms supported by their broker. After creating your account, log in using the credentials provided by your broker. Take time to explore the platform. Learn how to open charts, change timeframes, add indicators if needed, draw trend lines, monitor your open trades. The goal isn't to master every feature immediately. Focus on understanding the tools you'll actually use. Understanding order types. Before placing a trade, you need to know how orders work. The most common is a market order. A market order enters the trade immediately at the best available price. Then there are pending orders, which are executed only if the market reaches a price you've chosen. For example, you may want to buy only if price falls to a certain level, or sell only if price rises to a certain level. Pending orders help traders stick to their plans instead of chasing the market. The importance of stop loss and take profit. Every professional trader knows one thing: protection comes before profit. That's why every trade should include a stop loss. A stop loss is the price where you'll exit if the market moves against you. It limits potential losses and helps remove emotional decision-making. Then there's the take profit. This is the price where you'll close the trade if it reaches your target. Having both levels planned before entering a trade encourages discipline. Without them, beginners often hold losing trades too long or close winning trades too early. Risk management comes first. Imagine two traders. Both have the same strategy. Trader A risks 10% of the account on every trade. Trader B risks only 1%. After a series of losses, Trader A has lost a large portion of the account and feels pressure to recover quickly. Trader B has experienced the same losing streak but still has enough capital and emotional control to continue following the plan. This is why risk management is so important. The goal isn't to win every trade. The goal is to stay in the game long enough for your edge to play out over many trades. Your first trade. Let's imagine you've analyzed the market. You believe USD is likely to rise. You identify a logical entry point. You calculate your position size based on your risk. You place your stop loss below a recent support level. You set your take profit based on your trading plan. Then you enter the trade. Now comes the hardest part. Waiting. Many beginners constantly watch every tiny price movement. They panic when the market moves a few pips against them. They celebrate too early when it moves in their favor. Professional traders understand that once a trade is placed, the plan should guide the outcome, not emotions. Sometimes you'll win. Sometimes you'll lose. One trade doesn't define your success. Consistency over many trades does. Common beginner mistakes. Let's look at mistakes you should avoid. Trading without a plan. Risking too much on one trade. Moving your stop loss because you hope the market will reverse. Overtrading after a loss. Trying to recover losses immediately. Jumping from one strategy to another every week. Following random signals without understanding the reasoning behind them. These habits don't just hurt your account, they slow your learning. The faster you recognize and correct them, the faster you'll grow as a trader. Progress over perfection. No trader starts as an expert. Every experienced trader has made mistakes. The difference is that successful traders learn from them instead of repeating them. Don't aim for perfection, aim for improvement. If you're a little more disciplined this month than last month, you're moving in the right direction. If you're making fewer emotional decisions, you're improving. Trading is a journey, not a race. Part 4. Trading psychology, risk management and building consistency. Up to this point, you've learned what Forex is, how the market works, and how to place a trade. Now we're going to talk about the one topic that separates profitable traders from everyone else. Trading psychology. Most beginners believe that success comes from finding the perfect indicator or the perfect strategy. But here's the truth. There is no strategy that wins every trade. Even the best traders in the world experience losses. The difference is that they don't let those losses control their emotions or change their plan. The market is unpredictable in the short term. Your mindset is what determines whether you survive long enough to become consistently profitable. Fear and greed, the two biggest enemies. Every trader experiences two powerful emotions, fear and greed. Fear appears before you enter a trade. You start asking yourself, what if I'm wrong? What if the market reverses? What if I lose my money? Sometimes fear keeps traders from taking good opportunities. Other times, it causes them to close winning trades far too early. Then comes greed. Greed whispers, just a little more. Don't close yet. This trade could make twice as much. Instead of following their plan, traders stay in the market too long. A profitable trade turns into a losing one. The market didn't change, their emotions did. Professional traders don't eliminate fear and greed. They learn how to manage them. Think in probabilities, not certainty. One of the biggest mindset shifts you can make is learning to think in probabilities. No setup guarantees a winning trade. A good strategy simply gives you a statistical edge over many trades. Imagine flipping a weighted coin. If the coin lands on heads 60% of the time, you still won't get heads every flip. But after hundreds of flips, the probability begins to show. Trading works the same way. Your job isn't to predict every market move. Your job is to execute your strategy consistently and let your edge play out over time. Once you truly understand this, individual losses become much easier to accept. Risk only what you can afford to lose. One mistake almost every beginner makes is risking too much. Imagine you lose half of your account. To recover, you don't just need a 50% gain, you need a 100% gain. The larger the loss, the harder recovery becomes. That's why experienced traders usually risk only a small percentage of their account on each trade. Small losses are easier to recover from. Large losses can destroy both your account and your confidence. Protecting your capital is your first priority. Because without capital, you can't trade. Create a trading plan. Imagine trying to build a house without a blueprint. You wouldn't know where to begin. Trading without a plan is exactly the same. A trading plan should answer questions like, what markets will I trade? What time frames will I use? What conditions must be present before I enter? Where will I place my stop loss? Where will I take profit? How much will I risk? What will I do after a losing trade? When will I stop trading for the day? If you can't answer these questions before entering a trade, you're probably gambling instead of trading. Keep a trading journal. One of the fastest ways to improve is by keeping a trading journal. After every trade, write down why you entered, why you exited, whether you followed your plan, how you felt during the trade, what you learned. Over time, patterns begin to appear. You may discover you perform better during certain market sessions, or that most of your losses happen when you're tired or impatient. A journal turns every trade into a learning opportunity. Accept that losses are part of the business. Many beginners think losing means failure. It doesn't. Losses are a normal cost of trading. Just like a business has expenses, traders have losing trades. A successful restaurant still pays rent. A successful company still has operating costs. Likewise, successful traders still experience losses. The goal isn't to avoid every loss. The goal is to make sure your winners, over time, outweigh your losers. Develop a professional routine. Profitable traders often follow a routine. Before the market opens, they check the economic calendar. They review the charts. They identify potential opportunities. During trading, they wait patiently. After trading, they review their decisions and update their journal. Notice something important. Most of their time isn't spent placing trades. It's spent preparing and reviewing. Discipline happens before the trade, not after. The power of patience. One of the hardest lessons in Forex is learning not to trade. Yes, you heard that correctly. Sometimes the best trade is no trade at all. Many beginners believe they need to trade every day. They don't. Professional traders are willing to wait for high-quality setups. They understand that forcing trades usually leads to unnecessary losses. Patience protects both your money and your mindset. Success is built one good decision at a time. Profitable trading doesn't come from one lucky trade. It comes from hundreds of disciplined decisions made over months and years. Every time you follow your plan, you're strengthening good habits. Every time you manage risk correctly, you're investing in your future as a trader. Every time you review your mistakes instead of blaming the market, you're becoming more experienced. Success in Forex isn't about being perfect, it's about being consistent.